What if you could get a private investing lesson from Warren Buffett during one of the most chaotic economic times in modern history? Well, that's exactly what we're going to do. We are firing up the time machine and opening his 1981 letter to shareholders to uncover some truly timeless principles for navigating financial turmoil. So our destination is 1981. Just picture it for a second. We're talking long lines at the gas pump, headlines screaming about runaway prices, and this deep-seated fear that your savings are just melting away like an ice cube on the sidewalk. This isn't just a history lesson, it's a stress test for every single investing principle you think you know. The first thing that just hits you is the crushing weight of inflation. Prices are spiraling up at over 10% a year. If you think today's inflation is painful, just imagine that. Buffett himself called it the unrelenting destruction of currency values. Your money is literally losing its power right before your very eyes. Okay, but now here's the real kicker. The government, right? The safest borrower on the entire planet, is offering you a staggering 16% interest rate on its bonds. 16%! Risk-free. I mean, this creates an absolutely unbelievable dilemma for any investor. And that really brings us to the central question of the day. With a guaranteed 16% return from Uncle Sam, why on earth would you ever take the risk of buying a piece of a business? This is the exact puzzle that Buffett sets out to solve in this letter. So how does he solve it? Well, he doesn't start with a solution. He starts with a diagnosis of what he called the great economic sickness of the era, and what he found then is just as relevant today. And this one line just brilliantly illustrates the core of the problem. What Buffett's saying here is that the return from just sitting back and collecting interest on a bond, that's passive capital, was actually higher than the return from the average American business that was out there making things and selling things. That's active capital. So from this, Buffett created this amazing mental model he called the passive return crossbar. The best way to think about it is like a high jump. A business has to clear this bar. That is, the return you could get from a safe bond, just to even be considered a worthwhile investment. And here is the shocking reality of 1981, laid bare. That crossbar, that high jump bar, was set at a staggering 16%. But the average American business, it was only earning about 14% on its equity. I mean, just think about that for a second. The average company couldn't even clear the risk-free bar. And what this all leads to is a pretty stark and, uncomfortable conclusion. From a purely economic standpoint, most companies in America had become bad businesses. They were actually destroying value for their shareholders when you compared them to the safest alternative out there. So how did this happen, right? How did inflation create this bizarre, upside-down world where most businesses were failing their owners? Well, Buffett gives us the answer with one of his most powerful analogies ever. He calls inflation a gigantic corporate tapeworm. And wow, what an image, right? It's this parasite that secretly eats a company from the inside out, even while the company looks perfectly healthy on the surface. So here's how this tapeworm feeds. First, a business reports its profits for the year. But then, just to stay in the same place, inflation demands more and more cash just to replace inventory and equipment at higher prices. That tapeworm gobbles up all those reported profits before a single dime can get to the owners. As Buffett says, the plate is cleaned. This leads to a really profound and, frankly, a kind of terrifying lesson for all of us as investors. Accounting profits can be a complete illusion. A company can look amazing on its income statement, but if that hidden tapeworm is eating all of its cash, it is an economic failure for you, the owner. Okay, so if most businesses are bad, what do corporate managers do? Well, a lot of them fall for a fairy tale trap that Buffett calls the folly of kissing toads. So managers often see a struggling business, what Buffett calls a toad, and they think that because it's cheap, their brilliant management skills can be the kiss that turns it into a handsome prince. They truly believe their kiss packs some real dynamite. But Buffett, with that classic wit of his, just pours ice-cold water on this fantasy. He points out that in the real world of business, these fairy tale transformations are incredibly rare. The corporate backyards, he says, are knee-deep in unresponsive toads. So what does a real prince look like in this kind of inflationary world? Buffett gives us two key characteristics. First, it's a business that can raise its prices without losing all its customers. And second, it's one that doesn't need to constantly reinvest huge sums of money just to stand still. Now, you might be thinking Buffett is just sitting up on his high horse, pointing fingers at everybody else. But this is where the letter gets really powerful. This is when he applies these brutally honest standards to himself. He starts by reminding shareholders of his own prediction. He'd gone on the record telling everyone how optimistic he was about the future of the aluminum industry. And then, the punchline. He basically admits he was completely wrong, a full 180-degree reversal. And look, this isn't just a funny line. It's a masterclass in intellectual honesty, and it shows why it is so critical for any long-term investor to be able to admit when they're wrong. So after navigating the sickness, the tapeworm, and all those toads, what's the one big lesson we can take away from this journey back to 1981? Here it is. This is the golden rule. Forget about the reported earnings. Ignore the media hype. The only thing that really matters is how much real, spendable cash a business generates for its owners after the tapeworm of inflation and that crossbar of interest rates have taken their cut. And that right there is the timeless genius of this letter. It doesn't matter if inflation is high or low, or if interest rates are 16% or 1%. This fundamental principle of focusing on the true economic reality of a business, that never, ever changes. So I'll leave you with this question to think about. When you look at your own portfolio through this 1981 lens, which of your investments are the true, cash-generating princes, and which ones might just be toads, waiting for a kiss that's never gonna come?